Hey everyone, PayPal reported quarterly earnings results, and so I wanted to review those figures and update my buy recommendation for PayPal stock. Coming into the quarterly update, I had PayPal stock on my list of top 25 stocks to buy, so I had really high hopes surrounding PayPal stock for 2024. So let's jump in, let's look at the numbers, and then I'll update my recommendation for PayPal stock. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so PayPal reporting total payment volume of $403 billion with revenue growth coming in at $7.7 billion. And that's year-over-year revenue growth of 9%. The difference between total payment volume and revenue is that PayPal takes a percentage of the revenue of the transactions on its platform. It doesn't keep all of the money that's spent on the platform, using the platform, or transferred on the platform. It takes a piece of those transactions for itself. Now, transaction margin increased by 4% to $3.4 billion. That's another metric I was paying attention to, and you can see in the next chart I'm going to share with you acceleration in this trend. So I highlighted an acceleration in this trend, and you can see from negative 3% transaction margin dollars in Q3 2023, flat in Q4 2023, and now up 4% in Q1 2024. You can see steady and solid growth here in transaction margin dollars for PayPal. This is the difference between its revenue and the cost of revenue. It's similar to gross profit margin. You could think of it like that, although it's a financial services company. So it's hard to think of a financial services company as having any gross profit, but you can consider it related a little bit like that. With every transaction that happens on the PayPal platform, PayPal has an expense associated with it. And so what's left over is the transaction margin. And that's where PayPal stock investors want to see continued growth as well on top of revenue. Now, another key metric I had been discussing with investors on my channel is PayPal's active accounts. They had a several consecutive quarter streak of declining active accounts. As PayPal management has focused on more profitable customers, they've tended to lose millions of customers because they're no longer sending these customers promotions, incentives, and trying to re-engage these unprofitable customers, and so they're losing them. But this quarter was a welcome sign in that they reversed the trend. Active accounts increased by 0.4%, which was up by 2 million sequentially, and that was driven by lower churn versus 2023 and includes growth in PayPal merchant and consumer accounts. Both sides of the equation, not just consumers using PayPal, but merchants accepting PayPal. They are equally important for PayPal longer term to fuel that virtuous cycle. More people signing up with PayPal as consumers will make more merchants want to accept PayPal because they want access to those customers that use PayPal. And then the more merchants that are accepting PayPal as a payment method will make more people want to use PayPal as a payment. And so that just feeds on itself. That positive virtuous cycle has led PayPal to increase up to 427 million. But that virtuous cycle has led to a company like Visa to have more than 4.2 billion Visa cards outstanding right now. So that's where PayPal strives to get to, is that scale of accounts, merchants, and consumers. And that'll just feed on itself, and it can exponentially increase PayPal longer term. Now, I've mentioned that PayPal has been focusing on more profitable customers, and you can see the result here in transactions per active accounts increased by 13% to 60. So while they have fewer active accounts from several quarters ago because they were decreasing that amount, their transactions per active account is increasing because the accounts that remain are the more profitable accounts. And I've been talking about how I like this strategy. PayPal's not the only one that's implementing this more profitable customer strategy. This has especially been more prominent as the cost of capital has increased. Businesses have focused more on those customers that they can serve more effectively, not going after growth for growth's sake, but going after profitable customers. PayPal's another one of these companies that are doing that because it's more expensive now to generate losses on the bottom line. It's more expensive if your free cash flow is not growing at the rate investors expect. Your opportunity cost of capital has increased, so that makes it more important to generate profits and cash flow. PayPal's doing just that. I've liked this strategy. I've supported companies that are implementing this strategy. You might know a couple of Latin American financial services companies, including Nubank and what's the other one? StoneCo, that are also implementing a similar strategy, going after more profitable customers. And these are just 3 out of very many that are implementing this strategy. One notable exception to this rule is Sofi, which is another company that I recommend, but they're not implementing this strategy. Sofi is really going after growth, and they're just going after growth like expanding. They're not focused too much on profitable growth, even though they are increasing their profitability at scale because they're growing so large. But in terms of on the customer level, they're focused on expanding the number of customers rather than just expanding specific, more profitable customers like PayPal and some other financial services have shifted focus to. I highlighted free cash flow, and in the first quarter, PayPal generated $1.76 billion in free cash flow, which was 76% year-over-year growth. For the full year, PayPal is forecasting $5 billion in free cash flow, so it's ahead of schedule in that regard. So it looks like the rest of the year, it's not going to generate as much free cash flow as it did in the first quarter of 2024. Otherwise, that would mean that PayPal would generate over $6.6 billion in free cash flow. They didn't increase their free cash flow forecast for 2024, even though they did increase their earnings per share forecast, which I'll talk about after this slide. So they did repurchase $1.5 billion in their own shares. I've highlighted that when companies make this decision, it typically signals that they feel their stock is undervalued. I felt that PayPal stock is undervalued for, I would say, at least 6 months now. I've had PayPal stock rated as a buy, rated as a top stock to buy. And so it's understandable that PayPal management itself feels like the stock is undervalued. And they used nearly all of the free cash flow they generated in the quarter to buy back shares. They generated $1.76 billion in free cash flow, and they used $1.5 billion to buy back shares, which also highlights another reason why I like PayPal stock, is it's not a capital-intensive business. It doesn't need to use the money that it generates to reinvest in the business for growth. It can grow by attracting new customers and merchants to accept the platform, make the platform more attractive for merchants and customers alike. That doesn't always require a lot of capital spending. It can require just, imagination and looking at your customer service offering, looking at your customer value proposition and how you can enhance it to better match with the current attractiveness of your customers. So I like the business model. Again, another reason why I've recommended PayPal as a buy. So I mentioned the guidance. For the second quarter, they're guiding low double-digit growth in non-GAAP earnings per share and revenue growth of about 6.5%. They're also guiding non-GAAP EPS to mid-high single-digit growth, which previously PayPal had forecast earnings per share being flat for 2024. Now that was on a GAAP basis. They changed the accounting a little bit to give you a non-GAAP guidance of mid to high single-digit growth. I don't know just yet if those two different guidance are comparable. I'll look deeper into that and report back. But for now, it looks like they changed the way they're forecasting their guidance. Still, it's exciting that they increased their earnings per share guidance up to mid to high single-digit growth. If you don't already know, this means something like 6, 7, or I should say 7, 8, or 9% earnings per share growth. If it was mid-single digit, that would be 4, 5, 6%. So mid to high single digit is something in that range. So 5 to 9% earnings per share growth expected for PayPal. And then the free cash flow guidance was $5 billion 3 months ago when they gave their initial guidance, and it's still $5 billion. So they're not raising their free cash flow guidance. Now, PayPal stock is trading at a forward price to earnings of 12.45, which was up from, earlier in the year. It was trading at a forward PE of in the less than double digits, in the single digits, which, the valuation was one reason why I had recommended PayPal stock. So now, after reviewing their quarterly earnings results, I'm reiterating my top stock recommendation for PayPal. I still like the stock as a top 10 and top 25 growth stock to buy. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.